What's up, guys? Welcome back to the channel where I teach you everything you need to know about accounting, audit, personal finance, the CPA lifestyle, and everything in between. If that sounds awesome to you, make sure to hit that subscribe button below and welcome to the accounting channel. All right, guys, today we are going to talk about how to start investing. So I'm going to post the video. I'll pin the video somewhere right here. You guys can check out my investment strategy for 2022 and what I'm going to be doing. I'll be giving monthly updates on how that brokerage account is doing. But I got a really cool comment the other day on and I thought it was such a good comment because I felt like I was in the same position after I graduated college and started my career. I didn't know where the hell to start or where to invest or where to put my money or anything. So hopefully today with these kind of 6 steps I'm going to give you, you're going to be able to use these tools to hopefully kind of kickstart your investing career. And please, if you have any questions on how to open a taxable brokerage account, what to do, anything I mentioned in this video, please leave me a comment below. Honestly, guys, your comments are so useful and your DMs are so useful to me because they help me create, because usually if one person has a question, a lot of you might have the same question. And if there's any way I can add more value or help you guys through these kind of YouTube videos, podcast format, I'd love to. So again, this video is going to be for the person that maybe is just graduating college and now they're making a little money and they want to start investing now that obviously, they have their big boy job and now they're, balling out of control. This video is going to be geared towards that person. So if you're already all set up and, you're already a master and you're going to tell me I'm an idiot, this video is probably not for you. But hopefully it helps out those people that are just starting their careers in accounting and want to know where to start investing or how to even start. Again, I'm going to give you guys tips that I wish someone would have just sat down with me at 21, 22 and been like, this is what you need to do. So I'm going to give you guys the steps. So the first thing you need to do is you need to work on building an emergency fund of 3 to 6 months. And what I mean by that is you need to have liquid cash on hand to cover your living expenses for 3 to 6 months. This is bare minimum. This is the first step you need to do. Why do you need to do this? Peace of mind. Okay. I think, going throughout my career, I've learned that, the more money I've made, obviously it does provide you a certain sense of happiness and fulfillment, seeing maybe more numbers on the screen and whatever. But overall, I think what gives me the most peace of mind is knowing that, if something happened to me or my job or whatever, I'm covered. I'm good. I have enough cash in the bank to weather any storm, especially through the times that, it's July 19th, 2022, and things are tough right now. And, I think they're going to be a little more tough going forward. And knowing that you have enough cash on hand to cover you for 3 to 6 months, I think that's more than enough cash to weather any storm or, go through anything that might happen. I'll give you guys a perfect example of this too. So my first year in public accounting, again, no one really sat down with me and told me anything on how to start investing or what to do. But I just knew. I was like, oh, heck, well, I live at home. I'm not really spending a lot of money. And I've always been kind of frugal. So that kind of helped me a lot. But what I ended up doing, I just ended up saving a bunch of money. And at the end of my first year in my public accounting career, I ended up pretty much my car that I had in college that I hope to use for a few years after in my public accounting career, I didn't, ended up just breaking because I didn't change the freaking oil, and that was totally on my fault. I was an idiot, but literally the engine blew up. So I had to get a new car, and thankfully I had pretty much spent that whole first year saving up cash. So I was able to kind of, instead of it being a catastrophic event that was going to change my life forever, I was able to handle it because I had cash on hand and I was able to buy a car, no problem. I didn't have to rely on anyone. Obviously, it sucked and I didn't want to spend that cash on that. But, that goes to show you that having this emergency fund, especially, I don't know, maybe some of you have families, maybe you don't, but just being able to cover yourself for 3 to 6 months, being self-sufficient, not relying on anyone for anything, I think that gives you a peace of mind that you can sleep with every night, knowing that, you can go through anything reasonable, obviously, but 3 to 6 months of living expenses is more than enough cash on hand to, I think, be able to handle anything that might come up. So that's the first step. The second thing you need to do is you need to at least get your 401k match. So a lot of employers will do a 3% match or 6% match. You need to at least max out this much in your 401k. Usually, especially public accounting firms, they'll automatically enroll you in their programs. You need to do at least the match. Your employer is literally telling you, this is what's going on. Your employer is going to match up to a certain percentage of your income, or every so what ends up happening, let's just say they'll match up to 6% of every dollar or whatever. They're literally telling you, hey, if you contribute 6%, I will match that contribution. It's free money. Like every person that says do not invest in a 401k, honestly, I don't know what to tell them. I think at least to get the employer match, you're literally throwing away money and it's a tax deduction. Yeah, it's a no-brainer. So that's the first step. Just sit down, understand what you're investing in, obviously in the 401k plan, but just at least get the match. That's bare minimum. If they do 6%, do 6%. If they do 3, do 3. Whatever the match is, match it till there. And obviously, we'll come back to the 401k after, but at least get the match because it's literally free money. So that's step number 2. Get the employer match, make a contribution up into the employer match. The third thing you need to do, you need to open up a Roth IRA account. This goes without, oh man, I cannot stress this enough. What's in 2022, the maximum contribution you can make to a Roth IRA is $6,000. And why and what happens with a Roth IRA? So, and then I'll go over the differences between a 401k and a Roth IRA. So a 401k, a traditional 401k, you are putting pre-tax dollars that are not going to be taxed until you start taking distributions from it, which are, I think, 62 or 65. Forget the exact age off the top of my head, but essentially you're putting pre-tax dollars, so those dollars have not been taxed yet. And you're putting pre-tax dollars into account that when you take, the whole theory behind the 401k is when you take out the funds or the growth or whatever the case or whatever that those funds are, when you take them out of the 401k, you're essentially banking on the fact that you're going to be in a lower tax bracket. So when you take out the growth, those funds are going to be taxed at those funds are going to be taxed at whatever tax bracket you're in at that point. So that's a 401k. That's essentially what's going on. You're putting pre-tax dollars when you take out the money out of a 401k, any distribution that comes out of it, you're going to be taxed at whatever tax bracket you're in at that point. A Roth IRA, on the other hand, you're putting post-tax dollars. So the only amount that gets taxed on a Roth IRA the only amount that gets taxed is the amount that you actually put in. That's already taxed. The government already paid taxes on those funds. So the beautiful thing about a Roth IRA is any earnings you have on the Roth IRA, it could be at $5 million of earnings, you will not pay a penny in tax of it. A penny. I think that is incredible. I don't think so, everyone talks about so many different investments you can make. People don't talk about the tax implications of the investments that potentially you can make. And a Roth IRA, in my opinion, is probably one of the best investment vehicles for the long term because you put post-tax dollars that have already been taxed, and then any earnings you get in that Roth IRA other than the principal is not taxed. It blows my mind how people don't take advantage of this. So the third thing you need to do, you need to max out your Roth IRA. So whatever you need to do, put in $6,000. So what I do is I do $250 every bi-weekly. So every month I put $500 into my Roth IRA account, and I have been doing that for the past 7-8 years. And honestly, it's grown to a really nice amount that I'm very happy with. And I'm going to continue to contribute the $6,000 limit every single year until I retire. So the third thing you need to do, max out your Roth IRA because you do not pay any tax on the earnings of that. Again, just to review, 401k, you put pre-tax dollars, and those funds are taxed when you take distributions, and you might be at a lower tax rate. Roth IRA, those funds are already taxed, and any earnings you get on those funds that you put into a Roth IRA account will not be taxed when you take them out, regardless of what tax bracket you're in. All right, the fourth thing you need to do, once you have your emergency fund, you match your employer contribution on your 401k, you open up your own Roth IRA, and you're maxing that out, you need to pay off any consumer debt. This is a big one because consumer debt, all debt is to me that is not producing income, it's literally just like the Bible says, the borrower is servant to the lender. That's always going to happen. The more payments you have, the less freedom you have to make different investments, to make different decisions, to take a new job, to be able to do certain things. The more debt you have on your plate, the more you're strapped down and tied down to paying off certain things. And that's the worst thing that you can do. The best thing I think that money gives you is freedom. And that's one thing you should be chasing. And the more debt you take on, especially, guys, I'm telling you, please, clothes, cars, all that stuff. Do not be taking loans out for these things. These things cripple you in the long term and don't allow you to really live out your true life and freedom and do the things you want to do because you have certain payments to make. Pay off any consumer debt and do not take on any more consumer debt. The fifth thing you need to do, once you pay off your consumer debt, then now, so let's take a step back. Now we have our emergency fund. We're maxing out our 401k to our employer match. We're maxing out our Roth IRA. We have no consumer debt. If you could just do those 4 things, you're already like in the top like 98th percentile of people. I'm telling you guys, it is not that difficult to get ahead. It is not. So if you can do those things, now what you need to do, now you have, let's say you have some additional income. And mind you, while you're doing these things, you're going to continue to increase your skills, which are therefore going to increase your income. So your expenses are going to stay relatively the same, hopefully, and you're continuing to grow your income while you're already maxing out your taxable brokerage accounts, you're saving up, and now you need to think about, all right, what do I want? Like, what do I want to invest in? What are my goals? Do I want to buy a house? Am I getting married? Do I want to buy a car? Whatever your short-term goals are, call it 3 to 5 years, that's what you then need to save for. Again, when I wanted to buy my house, I wasn't putting that money into the market. I was literally saving up for a down payment on a home. So once I had the first 4 steps done, and guys, this took me a few years, okay? Hopefully you can do this in 6 months to a year. This took me a few years to kind of learn through trial and error. But once I had those first 4 things done, then I thought to myself, hey, I want to buy a rental property. That's what I want to do. And it took me a few years, and I wish I would have learned more on, you don't really necessarily have to put 20% or 15% or 10%. You can put as little as 3% down to buy a rental property. I wish I would have knew these things early on, but I didn't. And sometimes ignorance is bliss, and I just kept saving and saving and saving. And thinking back now, I could have bought like 2 or 3 properties with the down payment I put on my current duplex. So there's certain things that hopefully while you're saving up for whatever goal you have, you start educating yourself on what's the best way to utilize these funds, because it's your hard-earned money. You worked very hard for this money. So hopefully when you have this goal to start saving for something, you start educating yourself through the process and you start learning about how you can best utilize these funds that you've worked very hard to save for. So the 5th thing is start thinking about what else do you plan to invest in, or what short-term investments do you want to make that you can then utilize these funds to hopefully have a better ROI on your cash. And the 6th thing you need to do is you need to open up your own taxable brokerage account. Again, these are the 6 steps. If you haven't watched the video on my net worth of being around 500K at 30, I'll put it somewhere in the video here. These 6 steps are literally the financial steps that I kind of took to pretty much get there. So the 6th thing you need to do is you need to open up your taxable brokerage account. Again, once you've taken advantage of your tax advantage of your retirement accounts, which are your 401k and your Roth IRA, once you've completely maxed those 2 things out, then lastly, let's say you still, again, this is going to take time, right? Maybe you can't do this within a year, 2 or 3, but maybe by year 4 or 5, you're like, hey man, now I want to, I'm taking advantage of my retirement accounts. I'm saving up for a down payment on a rental property. I still have like, $200-$300 left over. I don't really want to spend it because, I'm already living within my means. I'm already really happy. I'm already going on, taking a trip here and there. Like, I don't just need to spend more to live this lifestyle that, that's not really who I am right now. I get more fulfillment out of investing and growing. Then you need to open up a taxable brokerage account. And I personally have mine at M1 Finance. I love it. And that's actually the one I'm sharing on a monthly basis. And I'm showing you guys exactly how easy it is to start investing. So once you check off those 5 boxes, you have your 3 to 6 months of living expenses, you max out your 401k, you open up your Roth IRA, you pay off any consumer debt, you're saving for some 3 to 5 year short-term goal, and you have some money left over, that's where you're going to start investing in a taxable brokerage account. And I'll be honest with you guys, even me now, I'm able to pretty much do the 5 steps that we mentioned earlier. And now the 6th step is I'm actually sharing with you guys every month, and I'm investing $1,000 a week into this taxable brokerage account. And I think I did the math. Like, if I keep doing what I'm doing based on what I have in it now, if I change nothing else and I just stick to the game plan and I invest in my taxable brokerage account, I will have close to I think $800,000 in this account by the time I'm 40 in 10 years. That's just crazy. That's just awesome. That, like, I will literally almost be guaranteed to be a millionaire by 40 just by doing these simple steps. So Hopefully with this video, you can start understanding and seeing and set a game plan and a blueprint for how you can start structuring your life, especially if you just graduated college and you're just starting your career. Start literally write these steps down, and hopefully they will help you kind of build a roadmap for yourself, and you can start setting 1, 2, 3, 5-year goals for yourself, saying, hey, by 5 years I want to have my 401k at this amount. But in 5 years I want to have my Roth IRA be at this amount, and I want to have an emergency fund, and whatever the case may be. This 6-step process, in my opinion, especially once you're starting your career, is probably the easiest route you can take, and it doesn't take much. All it takes is for you to focus, be driven, understand what you want, and stick to the game plan. All right, guys, it's going to be it for the video today. If you found value in the video, please make sure to hit the like button below. And also, guys, don't forget to add me on any social media platform you use. Till next time, work hard, dress well. Peace.